Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. Scott Hansen.
Pat McClain.
Glad you are joining our program today. Both myself and my co-host here, we're both financial advisors, certified financial planner, chartered financial consultant. We spend our weekdays with people like yourself and broadcast on the weekends to be your financial advisor on the air. We're talking about essentially just about anything related to finances. And love to take your call. The financial markets this year, they're always a little bizarre. They always go their own directions. No one can ever predict where they're going to go. But some of the swings that in some particular companies are just mind.
Oh, Scott, it is absolutely fascinating to me. How Reddit and pump and dump scams have actually gone mainstream, which you're like, what's pump and dump, right?
Pump up that stock. Let's get excited about it. Let's get other people to buy it. Let's get that price up.
Right?
And then let's be the first ones to sell.
So The Wolf of Wall Street, by the way, I'm not recommending movie, but The Wolf of Wall Street is about a pump and dump scheme. That's what it is about.
And it feels like this is just what people are doing on...
So in the last 6 months, we've seen two things emerge that would have been absolutely... And then the use of the SPACs, which is the special purpose acquisition company, which is companies that go public without any financials behind them, just give us money and we promise to invest them. And why do they do this? Why wouldn't a company? So they go out and raise money.
It was funny. I had an email exchange with a friend this week about it. He kind of was joking, like, when are you going to use the SPAC to take Allworth public? And I replied to him. I said, I said SPACs are going to end poorly for most investors. It's just going to be a transfer of wealth from middle-class investors, individual investors, to well-connected
rich people and oftentimes
and
now
celebrities.
Oftentimes now celebrities. So there's the things that have come out in the last 6 months, which I find absolutely amazing, which is how these things kind of emerge and then kind of go mainstream. And one is the pump and dump, and you see it with shares like GameStop and
AMC or whatever the next one is. It's all noise. You're not going to, by the way, it's not a good way to, you're not going to create wealth there. You're not going to protect wealth there.
A friend of mine called and asked, should I invest in this? I said, don't confuse it. It's not investing. It's speculating.
I got a text a week ago, Sunday morning, from a friend of mine. I thought it was a joke. What is your prediction on the future of GameStop?
Oh, you're kind of like, okay.
I have a feeling his son wanted me to ask.
Yeah, well, you need to get better friends.
Oh, I never talked to him again. I ghosted him. I deleted his contact, blocked him. I ghosted him.
You're the first 55-year-old that's used the word ghost.
It's probably, no one probably uses it anymore, right?
Ghosted.
My kids will probably look at me weird. Like,
and this SPACs, so what happens is these special purpose acquisition companies, they go public, and the reason...
It's a backdoor way to go public.
Because if they did it with a real company that actually had poor financials, they'd have to disclose it.
All kinds of disclosures.
And they're like,
millions of dollars in regulatory costs.
We don't really have to disclose anything. We're just going to raise the money, then go buy a company and put it inside. And it doesn't matter how big of a piece of garbage this company is that we're putting in there. We don't have to disclose it to the investors.
$70 billion have been raised through special...
Crazy.
Purpose acquisition. Not to say that they're all bad.
No.
And there'll be some good companies in them. The reason we don't like them
is lack of visibility and disclosure.
You're putting money, you're just on some and the financial rewards to the sponsors of them, the people that create them, 15-20% of the
right off the top.
Right. I mean, it's massive.
They just take it.
It's a huge payday
the way I
for the founders of it.
The way I like to describe it is, your neighbor comes over and says, hey, I got this great idea. I can't tell you what it is, and I want you to give me $100,000. Oh, by the way, only $80,000 of that 100 is actually going to get invested. The 20 grand I'm just going to keep for myself because I'm a great guy.
Because I'm going to find this great opportunity.
But I want you, your neighbor says, I'm going to give me the 100 grand, but don't worry about it. I'll buy something good. I can't tell you what it is. I can't tell you whether it's going to make a return or not. I can't even tell you the industry it's in.
Well, they maybe can sell the industry,
but it's going to do
and what
well.
the plans are.
Would you give $100,000 to your neighbor with that story?
I wouldn't put a dime in a special acquisition company.
Okay.
Special purpose
but
acquisition company.
It's an interesting world.
There's too many other great investment options. Why would I have to go to something like that? Let's hope that they've picked something good.
And their momentum. Remember, stock prices over the long term are driven by earnings, not stories, earnings.
Any business, whether it's a publicly traded one or it's the corner gas station, long term, the value is going to be based upon earnings.
Yes.
And what kind of regulatory burden the government might throw on top of it.
The same friend asked me, so what do you think about GameStop? And I said to him, you own your own business, right? He said, yeah. I said, you're focusing on the wrong thing. He said, what are you talking about? I said, you should be focusing on your business and how to make that better and less on GameStop and how you
If you think you're going to go to the financial markets to get rich, you won't. The financial market's a place to store your wealth, not to get... I mean, you look at the Fortune 400 top wealthiest people, how many of them are day traders? A few.
Yeah, there's a couple
hedge
funds in there.
There's a few.
But actually the hedge funds even use leverage.
But most of those hedge fund guys don't do well either.
Yes.
Let's be real. So,
if you'd like to join the show, you're welcome to join us at, what's our phone number? 833-99-WORTH. 833-999-6784. We're going to go to your calls.
Yeah, we're talking with Scott. Scott, you're with Allworth's Money Matters.
Hi, good afternoon. Greetings from Atlanta, Georgia.
Oh, good. Hi, Scott.
What can we do for you?
Question. The company that I work for is probably going to be sold this year, and I'm going to come into a bit of money as a result of that, probably between $650,000 and $700,000.
Is that
before taxes.
Are you a equity owner now, or some stock options?
Yes.
Or okay.
It's equity in a partnership.
Okay.
And really, the short question is, I want to know what to do with it. So my situation is this: I'm 56 years old, married. Have two non-dependent children, grown. The only debt that I have is a mortgage. Owe about $90,000 on a home that's worth about $425,000, and literally no other debts at all. So I presume I should pay the mortgage off.
Correct.
Do you want to double check that?
Correct.
I would. I mean,
yep. Pay it off.
And what to do with the rest of it?
What do you have in a 401k?
About $600,000.
And any other IRAs or other retirement saving?
No.
Will you have any pension income?
No.
Will you have another job after this company's sold?
Yes, I will. Nothing should change as far as that goes.
And does your spouse have money in a 401k or IRA?
She does not.
And what's your annual income ballpark?
Together, about $330K.
And what was your income 5 years ago or 10 years ago? Still somewhere in that range, or has it been dramatically different the last few years?
It's been dramatically different the last couple of years. I mean, 10 years ago, it's probably $125K.
Okay, got it.
And when was the last child, did they go off the support system called mom and dad?
They both still live at home, but they're completely, independent.
Other than food and the utilities and your wife
So
doing their
what
laundry.
we're trying to, so the reason we're asking these questions about your history is
How prepared are you for retirement, right?
Right.
So if you told me you were making $250 10 years ago, we're like, you're
You're
in real
wholly
trouble.
unprepared.
Yeah, right.
You're in real trouble if you're used to making 125. So based on this 330 salary, you should push all of this into a brokerage account. Pretend you don't have it, invest it for retirement. So when you say, let's say it's 700, you're going to lose a third of that in taxes, assuming
Maybe
it's
not quite,
long-term
but-
capital gains. And I don't know what the taxes are in the state of
I don't
Georgia.
either.
So assume about a third of that. So
Probably a little less, but yeah, you might have some cost basis too.
Yep. So let's say it's 500. You're going to take 90,000, pay off the mortgage. Now you're down to about 400,000. Then the question is, how do we invest that 400,000? You invest it for retirement, but you do it in a brokerage account.
You maximize both your 401ks, particularly at this high income level. You want to make sure you're maximizing both your 401ks.
You want to fund Roth IRAs. for both you and your spouse. And then the rest of it, you're going to invest as tax efficiently as you possibly can towards retirement.
How much can I put into a Roth?
You'd have to do what's called a backdoor Roth IRA. Do you have any other IRAs?
No.
So you can, between now and April 15th, you can put it, was it $6,000 or $7,000?
He's 56, so I think it's 65, 7,000.
7,000 for 2020 and 7,000 for 2021. And then explain how
So what happens is when you put the money in, you're going to put it into a non-deductible IRA. So you're not going to get a tax deduction. You're going to do it for both you and your spouse. And then the very next day, you're going to convert it to a Roth IRA. And because there's been no gain in that, there's no tax in that conversion. If you just left it in the non-deductible IRA, which would be fine, the money, any gain that comes out when you take the withdrawal would be taxable. The gain would be. So by converting it to a Roth IRA, it converts it to a tax-free withdrawal at some point in the future. So you want to do that for...
Well, if you have the cash now, or you can just do for 2000. You have until April 15th to do 2020s. If you had this money today, we would argue do both years. But if you've got the cash to do it, I would highly recommend that. If you don't, then you want to start doing that as soon as you have the cash. Our concern, I'll be real transparent here. Our concern is that retirement's going to come, and you're going to have a tough time replacing your income.
A very difficult time.
Understood.
Yeah. So with the right kind of planning, assuming you're going to be working a few more years, the right kind of planning, this transaction can certainly help you get nice, secure financially and get your retirement on track. But there's still some work to be done there. I 100% agree with Pat. I would have it all geared towards
I'd probably have
retirement.
A portfolio of 60-70% equities and the rest bonds and cash. Maybe a little bit of traded real estate investment trust in there.
Don't go buy a new boat.
Yeah, do not.
Right. I hear you.
Pretend like you didn't earn it. And by the way, you did earn it. You just earned it all in a lump sum. You've been earning it for all the years that you worked at this company, and now the payday comes in.
Yep, and for sure pay the house off first.
Oh, 100%, 100%. And then it may make sense for you to sit down with a qualified advisor to actually make sure that you actually pick a date in the future and then determine how much your income needs will be at, let's just say, okay, I'm going to retire for real at age 62 or 63. How much money am I going to need in retirement, and what do I need to get there, and how aggressive or how conservative my portfolios need to be, and then what tax advantage ways can I get there? One of those ways I could just tell you, it comes off. The first thing is put as much as you possibly can into your 401ks, then put money into a non-deductible IRA and then convert it to a Roth IRA. And for the rest of the listeners, if you've got an existing IRA, don't do what I just said.
Or it's not going to work.
Or it's not going to work. It's only for those people that don't have an existing IRA that these non-qualified contributions conversions to Roths work. But this is a great time for you to actually sit back, take stock of when a real retirement date is, and plan towards that. Did that help, Scott?
That's great. I really appreciate it.
Is there already a transaction? Have you guys already inked a transaction, or is this something that's still in the works?
Due diligence phase right now.
Oh, good for you. So there's an LOI, a letter of intent out there, and they're in due diligence, right? Are you rolling over any equity?
I don't know if that's going to be an opportunity or not.
Got it.
I was going to bring that up, but I don't know at this point.
Okay, and it depending upon what you're rolling it into, oftentimes it makes a lot of sense for both a deferral of taxes and growth on the portfolio. And you would actually just
depending on the industry and the company and everything else. Correct,
and you would factor that in as a stock portion of your overall portfolio going forward. So let's say you rolled over 10% or $75,000, you would actually look at that when you build the models of the portfolio as a 100% equity position, highly concentrated. But a good advisor would walk you through that.
Great.
All right,
Very
Scott.
good. Thanks, guys.
Yeah, glad you called. If you want to be a part of our program, 833-99-WORTH is our number.
How exciting for him.
Yeah, you've been at a company a long time, and you got some transaction happening.
Yeah. And the idea is people have a tendency to think this is a windfall. It's not a windfall. You've been working for this for years. It just got paid all at once.
Funny. I almost said windfall.
A windfall is when grandma or a great
someone you don't even know is
died.
expecting. That's a windfall. You've been working your butt off for a company for years, and something happens, and you get some pay out of it. That's a return.
It's deferred
fruit
income.
of your labor.
Yeah, it's deferred income. It's not a windfall. So
So
don't treat it like you won the lottery.
I had a
and actually, if you win the lottery, don't treat it like you won the lottery.
I was talking to someone about I don't know, some stupid lottery conversation. It was a family member's friend, and I said I wouldn't want to win the lottery. The problem with it is everyone in your life knows it's just like free money, and that people just start lining up. I said I wouldn't want to win the lottery, and she says, well, it looks to me like you already have won the lottery.
Is that right?
And I said, excuse me?
You won it.
You mean when I moved to Sacramento and I rented a bedroom out of someone's house, it was $300 a month. There were months I didn't have the $300 to pay the rent.
When your
had to use
Toyota,
my engine fell out of my Volkswagen Jetta.
Yeah, that was what it was.
My velour interior on my 10-year-old Toyota Camry that I would use to drive around.
The engine fell out of your Jetta because the motor mounts broke?
Yeah. I don't know how to check those things very well, but it might have been a basic fix had I known what a motor mount was.
So you didn't win the lottery. You kind of worked for it.
Kind of,
You won the lottery growing up in America.
Yeah.
Right?
There's no question.
You won the lottery.
And while my family wasn't a perfect family, I never was...
You won the lottery because you were highly educated. You had the ability to
And I won the lottery.
college.
I've got a decent intellect.
Yeah, you won the lottery because you're a great business partner.
Well, there's no question.
How did I leave?
I mean, usually when I say my blessings at night, Pat McLean's the first time I
Right? How could I leave that out?
Well, because you just figure it's so obvious. Like when I go through the list of things to be grateful for, it's usually Pat, then it's my wife. All right, let's get back to calls. 833-99-WORTH is Allworth Financials' number. We're talking to Link. Link, you're with Scott Hansen and Pat McLean.
Hey, good day, Scott and Pat. How are you? Hope
we're good. Thank you.
You're having a good day.
Yeah, we are actually having kind of fun.
I have a specific question about a brokerage account. I have about $100K in a brokerage account, invested 20/80, 20 in bonds, I should say, and 80 in equities. They're all mutual funds invested. But I'm looking for changing the equities aspect of it to be using ETFs. Are there particular ETFs that you would recommend? I would like to cover like the total market.
Okay.
Well, it may or may not make sense to. I mean, let's assume you bought a mutual fund that you paid $10,000 for it, and it's worth $19,000 today. It might not make sense for you to sell that thing because the tax you'd have to pay. So even though you might get an ETF with a lower expense ratio, the expense of the tax man on that transfer may or may not make sense.
So what is the basis in the equity portion of your portfolio? So you have $80,000 in stocks, in equities in the portfolio. What is your cost basis? What did you pay for those?
They're roughly they're split. 40% is in U.S. and 40% in international.
Yeah, but what did you pay?
The cost? Yeah, the cost basis is around 0.04.
No, that's the expense. That's the expense ratio. Your cost basis is how much you invested. So those are the expense ratios.
Let me step back further. Your mutual fund expense ratios are 0.04. And you want to sell those to buy ETFs? Why?
You're not.
I wanted to be from a tax perspective. I wanted to be a little more tax efficient annually because I was using. The intent is to use this as an annual distribution for vacation, not for retirement, right? So this is strictly for money that would be used within the next 3 to 5 years for vacation.
How much will you be taking out of the account each year for vacations?
Roughly 2%. You know,
a couple
nothing
thousand
more than that.
Oh, okay.
Yeah.
Then then I'm comfortable with the 80% equities.
So how much did this 80,000? So you gave us a number 0.04, which is the expense ratio on these. Which, by the way, are they index funds?
Yes, they are.
Well,
They're both index funds.
Okay, so what the idea of going to the ETFs is to create more tax efficiency.
Where? What tax efficiency?
I would make the argument that it's not worth the exercise because the ETFs aren't that much more, or if any more, tax efficient on the index side than they are on. So an ETF, the difference between a mutual fund and an ETF on the S&P 500 is the ability to buy and sell those shares throughout the day versus at the end of the day.
They're structured slightly different, but 98% the same.
Yeah. So the difference between...
And the securities are the same.
So if you bought, let's say, State Street S&P 500 or Vanguard S&P 500, Standard & Poor's 500, or you bought an ETF S&P 500, the differences between the two is...
So negligible.
It's negligible. Even the expense ratios are negligible.
I mean, if you had $100 million in the account,
but
maybe you'd look at... But
the difference is you want to buy the Vanguard, you do it at the end of the day, right? For most mutual funds. But some of them have actually changed that you could buy them midday, but they're priced at the end of the day. You buy an ETF, you could buy and sell the thing 2 or 3 times.
And unless you want to
day.
use ETFs that are actively managed or picking some sort of sector, which I think fools play, I wouldn't do anything. I wouldn't change this.
Link, I wouldn't. Right?
Okay, thank you. I appreciate your suggestions, and I agree that I do not. My intent is not to be doing day trading with the ETFs. Okay. It would just be something that it's invested $40K for US, $40K for international.
That's fine. It's probably you're overweighted a little bit international, in my opinion, but you're not going to hurt yourself there. It's just going to, the volatility in the portfolio is going to look a little bit different, but over the long term, it's going to react the same. But I'll use an analogy. My wife, who I love dearly, 35 years, she can see inside of the house repainted pretty often. In fact, the house shrinks every couple of years. We've lost like 50 square feet because the inside.
How many times have you actually had that inside of the house painted?
6.
So as soon as it gets a few nicks here or there?
Yeah, but the point being is she'll bring in and paint color swatches on the side and say, well, which one do you like more? And I'll say, I can't tell the difference between this color and that color. They're the same to me.
Aren't you colorblind?
I'm partially
okay.
colorblind. Okay, well,
there is that.
Bad analogy. But you get the point. Like this exercise of going through this is for naught. It's for naught. Just leave it alone.
Okay. Thanks again for your time. I appreciate it.
Right,
and
no
like
worries.
I said, this is just for
Perfect.
We're locked down with COVID. So I mean, I've got a couple of years that's piling up here, and it's just accumulating.
Yep.
But in terms of setting up automatic distribution annually, do I need to contact my brokerage firm to have them set that up, or can I do that online?
But just go grab it when you need it.
But better yet, just have them issue a checkbook with the brokerage account, and then look to make sure there's enough cash in it. When you want the money, just write a check to yourself. That's the easiest way to do it, and then you don't have to talk to anyone.
Oh,
or you can set up,
idea.
an online. You can set up link your bank account to it.
You could do that.
You go online, say send $2,000 to my bank account.
That just make sure you have enough cash in the account. But you don't want to set up an annualized distribution at a certain time because then you lose flexibility. So either you do it electronically or you have them issue it with a checkbook.
Excellent.
All right.
Thank you very much.
All right. Wish you well. And you might own a mutual fund that has actively managed, where the manager has underperformed the index the last couple of years, where the expense ratios are somewhat high, and it might make absolute sense for you to keep it, and would be a big mistake to sell it
because of
the tax consequences.
Yeah.
And I could think
what you do first is you stop dividend reinvestment and gain reinvestment capital
immediately.
That's the first thing you do.
But I mean, we probably have hundreds of
millions of dollars of things that we might not buy today.
We would not recommend today because someone joins us, they already have some position in something, or maybe it was a fund that we recommended 20 years ago that has large capital gain. We don't want to pay the capital gain, and particularly with the way the current estate tax rules work, if we pass away and own a community asset with a spouse, that property receives a stepped-up basis. So If you paid $20,000 for a mutual fund that's now worth $100,000, if you sell it before you die, that $80,000 of gain is going to come right through to your tax return. You wait till you pass away, your spouse inherits, they inherit it just like you paid $100,000. All that capital gain is forgiven. So just because you've got something that maybe is not the best performer, maybe it has high expense ratios compared to what you can get on a new ETF today, don't just sell it because...
And ETF means exchange traded fund.
You might have greater wealth owning that thing, and you'll cause a big tax bill for nothing if you make a change. So anyway, it's something to consider before you just focus on expense ratios. We're going to take a quick break. When we come back, we'll continue on with calls. This is Allworth Money Matters.
Can't get enough of Allworth's Money Matters? Visit allworthfinancial.com/radio to listen to the Money Matters podcast.
Welcome back to Allworth's Money Matters. Scott Hansen.
Pat McClain.
Having a good time here this weekend. And let's go back to the calls here. Talking with Diana. Diana, you're with Allworth Financials Money Matters.
Hi. Thank you for speaking with me. I really appreciate it.
Our pleasure.
Thank you.
Thank you. Yeah, I've been listening to you guys since the mid to late 90s.
Oh, my gosh. That's about when we started. Mid-90s.
Yeah, exactly. Yeah, exactly. When you were just on that one.
Please tell me you have no savings and just credit card debt. Don't tell me that, please.
No.
After 25 years of listening to us.
No, I've learned a lot from you. I
Good.
think you'd be proud of me.
We are, actually. Thank you.
Oh, thank you. So I retired about 7 months ago, and because I didn't like working from home all the time with the shutdown, and I looked at my finances. I figured I could afford it, and what I was calling today for is I'm wondering. I know you've always said like when you retire you should have your house paid off, which I do not.
Well, for most people, it makes things easier, so that's why we're fans of it.
Right.
Not for everybody, but most of the time.
Yeah. Okay. And then I know you've also said in some cases it might be worth refinancing to lower your monthly payment.
That's right. You're getting a new 30-year mortgage. And
sometimes it makes sense to use a reverse mortgage, so there's no payment at all.
So your question is to pay down the mortgage?
Yeah, so my question is, like, what sort of things should I actually take into consideration while I'm trying to make the decision, like whether I should just continue with my current mortgage or whether I should...
How large is your mortgage? How large is your mortgage?
It's not very large. I currently owe $104,000.
And what's the value of the home?
It's, according to Zillow, which I know you got to take that with a grain of salt, but Zillow says it's like $470,000.
And how old are you?
59.
And tell us about your other assets or income. So do you have a pension you're receiving?
No, I did. I took, when I retired, I did have the option of a pension. I took the lump sum and just moved it into my rollover IRA because I wanted to have the control over my money.
And how much money's in the IRA?
Just a little bit over $1.9 million.
Oh.
And how much did you earn at your job prior to retirement?
When I left, I was making like around $175,000 a year.
Are you married?
No.
Are you supporting anyone?
No.
And what other assets are there outside of the IRA?
Just a little bit in savings, but all my money is in my...
And what's the interest rate on the mortgage?
3.0%.
And how many years left on it?
It matures in 8.5 years, but I think I've always paid like a little extra each month.
What do you mean matures? Is it a 10-year fixed rate or something?
Yeah, or it was a 15-year. I refinanced.
Okay, so it's paid off in 8 years.
I wouldn't do anything with this.
Okay.
And how much money are you taking from your IRA to live on an annual basis?
Well, I just turned 59 and a half, so I just took my very first distribution. I'm gonna allow myself $72,000 a year. So I'm just taking out $18,000 every quarter.
And why quarterly? Why not monthly?
I've thought the same thing. She obviously is plans her finances well.
Yes.
So
I just figured, I don't know. I just figured it was easier if I just did it quarterly instead of monthly.
It might be easier to set up on a monthly basis. What we don't want you to do is, when the markets go through a downturn, which they will, and you see the value of this $2 million fall to 1.6 or 1.5, we don't want you to think, I better cut back my income because the markets are down. You're at a distribution level that's comfortable.
Yeah, it's less than 4%. When Social Security, if you can live comfortably on this, when Social Security kicks in at age 62, you can lower the distribution even more. I don't know if, I mean, the only thing I would think about.
If you had $104,000 just sitting in the banking account somewhere, I'd say take it and pay off the mortgage, but you don't.
But so Scott, let's think about this. So if she's taking out $72,000 a year and you had income you won't have any income this year. You quit work a few months ago, right?
Yeah, last summer.
It might make sense to take a little bit more out on an annual basis and pay this thing off over 3 or 4 years, depending upon the marginal tax rate.
You're pretty much in a lower tax bracket. I wouldn't want to push it up.
Right. Yeah, that's why I kept it to around.
How much is your payment? How much is the payment excluding taxes and insurance?
$1,340 a month. So it's not too bad. I mean, it's not too.
You could refinance this thing into a new 30-year, but I don't think I'd go through the hassle. I think I would just leave it alone. You're living comfortably.
Yeah.
And once you're living comfortably, the payment isn't a struggle for you. You're achieving your objective.
You've done a great job saving. You've got a boatload of money in your retirement account. What you don't have is money sitting outside of that you can take and throw it against that mortgage.
But that doesn't bother us because you're just matching the debt against the asset.
I wouldn't pay any extra on it.
I wouldn't pay any extra. I know that.
Okay.
We don't want you to sacrifice a lifestyle today for your home to be paid off in 7 years.
When you die, who's the money go to?
It'll probably go to my best friend. We've been best friends for like 50 years.
Yeah,
so
you know what? I'll tell you what. So, listen, if you were my client, I'd say make the minimum payment you possibly can. And at age 70, if you're sure you're going to live in that house till you're dying,
or maybe even get a
reverse mortgage at 70, 65 or 70.
Yeah, so that's the other thing. I don't know if I love the house itself, but I don't know if I want to stay in California because of the financial mess that our state is in.
I've never heard that.
Yeah, I know. This is a news flash for you guys.
So
actually, they're not in financial. It's a surplus for now.
Oh, come on, Scott. The budget is a surplus, but the deficit is. So I wouldn't do a thing. I wouldn't do a thing. I would certainly not make any extra payments on it at all.
Okay.
And maybe do a 30. I mean, if you did a 30-year mortgage payment, your payment probably be like $500 a month.
And
not
then,
counting tax and insurance.
You know, but would you go through that $104,000? She's going to get the interest rate's going to be about the same.
I'd just leave it alone.
I'd leave it alone.
Just make sure
that you're living comfortably.
Yes. Right? Don't skimp on me. Don't skimp on meeting your friend for lunch because.
Yeah, I mean, even if you increase your distribution to $80,000 or $85,000 a year, if it allowed you to live more comfortably, and
particularly between now and Social Security,
which is then you could your Social Security will be what $1,800, $2,000 a month,
something like that. Yeah.
Yeah. So take out an extra, $500, $800 a month now to live more comfortably, and then when Social Security kicks in, lower that distribution by the same amount that your Social Security
Or another way to look at it, peel off $104,000, make a separate IRA, have a check to make that mortgage payment taken care of each.
But that's a psychological. She's got the I wouldn't do a thing.
And I think the reason we want to make sure that you saved a lot of money, right? You're just you need to take care of. Your house is almost paid for. You're in great financial shape. You're living fine without being on Social Security. If you could tell us for certain the day you were going to die, and also the day your health might be failing, where you're not quite as mobile and whatnot, the planning would be really easy. But we need to. It's the balance in between. We might live till 100. Or we might die in the next couple of years.
Yeah, if you were...
right now we're relatively young. Right now,
yeah, as long as you're living comfortably, and if you need more income, increase this until Social Security kicks in. You'll take Social Security at 62. And when Social Security kicks in, then you'll lower your distribution by the amount of Social Security and allow you to catch up on the portfolio. But I wouldn't worry about the mortgage. Don't pay extra.
No, I wouldn't pay extra. That's for sure.
All righty.
You did great. You've done great.
And thank you. I have one other super quick question, if you don't mind, about I believe I recall you guys saying that like when people retire, they should not have like all of their money in equity. I've been 100% in equities up until November, and then I took like 5 years worth of money out of my equity
You want a job?
fund. And
would you like a job as a financial advisor?
Sure.
I mean, you've done it. That's exactly the right
thing. I'm trying to like manage my friends' money, but they won't let me.
Oh, that's a dangerous. So you took out 5 years of distribution, or approximately $350,000 on $1.9 million, which puts your portfolio to about 80-20.
Yes, I wanted to ask you. I moved the 350 into a actively managed short-term government bond fund, and that's what I'm going to withdraw my
great
distribution from.
Yeah.
Is that an okay? I don't, because I've been 100% equities forever. I didn't know if like that was a
well. I mean, it's not like we just say this fund's a great fund and that fund's not a great fund. We use a variety of funds that are designed to work in tandem with one another to accomplish certain objectives. So while this isn't the approach that we would necessarily take, I think you'll be okay in this approach.
I would have actually put a little bit more in. I wouldn't particularly use that fund, but your portfolio, right now your portfolio is 80-20, about 80% equities and 20%. I'd be a little bit, quite frankly, a little bit more comfortable at 70-30. I don't know if I would have dropped it all into a particular fund that you mentioned. In fact, I can tell you I would not have. But overall, the portfolio should probably be 70-30. Okay. All right.
What sort of other fund types would you recommend?
Well, I would stick on the shorter end of things. But there's also there's some corporates in there that you can get a little. It's a weird bond market, right? Junk bonds right now are paying 4%, which is crazy.
Yeah, you don't want to load up on that. It's okay to have a little bit of the portfolio in that, but the world is not black and white. There are shades of gray in our world, and what you just did was a black and white move. I think the overall objective is the portfolio should be 70-30, and I would probably use 1, 2, or 3.
And the reason Pat says 70, it's just what happens. What happens if we have a 40% market correction in the next 12 months? That's within the realm of possibilities. Not that we're predicting, but it's in the realm of possibilities. You have a major market correction, and how is that going to impact your life?
That's right. So
are you now going to say, oh, I better skip that lunch with my friend this week because my $2 million account's only worth 1.4?
And the reason it's 70-30 is it's just taking a little bit more risk out of the portfolio, which, by the way, you don't need that much risk now. You got to where you're going to go, right? Mm-hmm. And so you making more money and allowing your friend to inherit more money at your death isn't going to make any difference to you over the long term. So the portfolio making it a little bit conservative is fine because the direction for the dollar's downstream.
Yeah, you were wise by taking some money out of it.
That was brilliant.
Perfect.
It was brilliant. It was brilliant.
And whether you're 70 or 75 or it's kind of
okay. So what other funds types could I research? Would
corporate.
You recommend that
I'd put corporate. I'd put short to medium term corporates in there. You're going to get a little bit higher yield on them, and you're going to diversify the risk. All righty.
Okay.
Appreciate the call.
Okay. Thank you
All right,
Thank
Diana.
you so
Yeah, glad you called. Let's continue on here. Talk with Sharon. Sharon, you're with Allworth Money Matters.
Yes, hi. Thanks for taking my call.
Yeah.
And
Are you on a speakerphone?
I have a headpiece. Do you think I should get rid of this?
I don't know. You sound like you're
that?
booming. You sound like you're in a big room, but it's okay. Whatever.
Okay,
Yes,
wait,
we'll go with that.
let me just talk on the phone straight. One
Okay,
minute.
thanks.
We'll go ahead and wait.
Okay. We need some elevator
Does this
music.
work better?
Oh,
There
it's
we go.
so much better.
Yes.
What can we do for you?
Okay. Okay, great. So I had a question about funds that I have in my 401k. I have about $500,000 that's split between Fidelity's Contra Fund and Parnassus. And, you know, I've had them for about, I guess, 10 years or so. And, you know, no complaints. But I was wondering about, since both of these are large cap funds, I was thinking that should I perhaps be migrating some of the money more to a mid cap or perhaps looking at index funds?
So
that's
your
kind of
your
my-
500,000, you only own 2 mutual funds?
Okay, so yes, I own 2 mutual funds, and then I have a little bucket that my ex-husband manages, just of stocks.
So if you came, let me say, let's Sharon, let's say you decide you're going to hire a financial advisor, and you went and saw that financial advisor, and that financial advisor said, "Let's take your $500,000, and we're going to buy Fidelity, one of these Fidelity funds, and we're going to buy this other 2 actively managed mutual funds, 2 mutual funds, U.S. large company stocks." What would you say to that advisor?
I really don't know.
Okay.
I'm
You
not-
wouldn't hire them.
you know,
You would not hire them.
So,
okay.
I mean, the way we would come about something like this, I mean, someone who's got $500,000 in a retirement account, the nice thing is there's no tax consequences. So you can sell a fund at any particular time. You don't have to worry about any tax consequences. But would probably have 12 to 14, maybe 15 different positions.
It doesn't cost anything. There's no tax implications.
Mostly
in moving around.
index funds, but you'd want to. There's some but clearly large cap, mid cap, small cap, a little bit of international. I mean, there's a variety of different things, and then there's times you might want a little bit of real estate in there, and times you might want some emerging markets in there, and so I mean, we would definitely have a different approach than having two funds.
Yeah. Would you? I would never go
Okay.
to a restaurant that only had 2 things on the menu.
I was
Okay.
at In-N-Out last night. There's not much more than 2.
But
You
to
can
me,
have
Burgers
it
and
is
fries.
satisfying
I know,
there.
but you could have the burger. You could have it animal style.
That's so my kids had animal style. last
Right.
night.
You can have it with
It's
cheese.
30
without
minutes to get through
cheese.
drive-through. That In-N-Out is crushing it.
That is a commitment to a burger. Something
I'm
that-
already in. I just know where I could go.
Scott, that is a commitment.
What am I going to do? I'm there.
That is a commitment to bad health.
My wife
that a
was
lot
at-
of people would
My
not.
wife was out of town. I am responsible for feeding the kids.
That is a commitment.
Burger, fries,
Is
and
that
shakes.
right? What was the AM PM closed? Is that what happened?
No, we got the hot dogs the night before at the AM PM.
did you?
No, I'm
you
joking. I haven't eaten
didn't.
hot.
All right. Well, back to this call, Sharon.
Okay.
Those 2 choices, although they may be part of the alternatives, it's too small. It's too narrow. Your portfolio shouldn't be built like that.
Okay.
Have go talk to 2 or 3 financial advisors. Get some consultations. Get some ideas on how to best structure this.
Yeah, you can call a firm. They'll charge you a fee to allocate a portfolio.
Or they'll just get.
But this money's in a 401k, correct?
That's correct.
Yeah.
Are you still working?
No, I'm 73 and I've been retired.
Oh, okay.
Okay. Yeah.
So
You
here's
sound
the-
much younger.
Okay, I thought you were in your 50s, early. You need to roll this
Yeah.
into an IRA. Hire a good financial advisor. Pay them their percent or somewhere around there to manage the money, and
You'll
then
be well served.
You will be well served.
You get the
Absolutely.
right kind of diversified portfolio. You have required minimum distribution issues you're dealing with, how to best structure that.
Yeah, whether you should use qualified distributions to a charity. There's so many things. And by the way, you're comfortable giving up control. You allow your ex-husband to manage a portion of your portfolio in individual stocks.
Yes.
Right?
Wow.
That's comfort. That's a you know that you obviously have a great relationship with your ex-husband. Or
well, I'm sure there's some things she liked about him. Just certain things just didn't work.
Yeah, sometimes it's easier when it's ex.
All right, so you need to hire an advisor.
Yeah, I appreciate the call, Sharon. I think you'll be just talk to a couple and find something you like. Yeah, make sure they're credentialed
and make sure they're
experienced and fee based, not selling you any product.
If they try
don't buy an annuity or anything.
Don't buy it. Don't go to the bank and let them.
And don't go to someone who's going to start talking right about investments. The idea is like Sharon. Okay, great. You save these dollars. What are we trying to accomplish with them? What's the objective here? How much the income do we need? Do we need income? What about the requirement distribution?
So to follow up on the question so you bring the kids to In and Out because your wife's out of town and you're watching them.
There's lacrosse practice and there's at the same time, and they canceled my 10-year-old's practice, but not my 13-year-old's practice.
Oh,
and it was because of thunderstorms. So I get an email of the one practice being canceled, but not the other. So when I went to pick up my younger one, the other one's still practicing, so we had about 45 minutes. So we thought, I'll go to In and Out. I thought it'd be quick, but it was long. It took about over 30 minutes to get my burger
and what
are
you making them for dinner tonight?
I think that far? I think we're going to dinner somewhere tonight.
Like pizza or something?
I barbecued chicken and tri-tip the other night with broccoli and salad and mashed potatoes.
Mr. Mom, right there.
Huh? And I had made a little leftover chicken, so for lunch they got chicken with some vegetables.
Oh, very nice.
Salad.
Look at you.
Yeah.
Looking forward to when your wife comes home.
Oh my gosh, that, and we have a puppy too. And between the two, the puppy's 4.5 months old. He's actually pretty smart. He's mostly potty trained, not entirely. And then if you're not careful, I was working. All of a sudden I hear this chewing. I thought he was chewing on a toy. I look. This is like brand new chair that my wife had bought. He's chewing on the leg of the chair.
Oh no.
I'm like, that's not going to go well. I'm looking forward to my wife being back. House is falling apart. Kids are going to have hardening of the arteries.
We're all taking we're taking months off our life expectancy while my wife's gone.
Yeah, I hope she's having a good time.
I mean, you were pretty committed to a meal that's not really good for you at the In and Out.
It was good psychologically. It was pretty tasty.
Who doesn't love the In and Out?
I mean, In and Out doesn't get much better than that.
I got to tell you, I have to go. I go to a McDonald's about once every 8 weeks.
Are you kidding me? I haven't eaten McDonald's in years.
It's this comfort. It brings me back to.
But a Big Mac sounds pretty dang good right now. Yeah. Now you mention it. Yeah. I'm going to have one in the next couple of weeks. I've made that decision.
Congratulations!
I'm going to start eating more burgers.
Yeah, you gotta eat the fillet of fish too. No,
that sounds disgusting. All right, let's go to the calls. I don't like fillet of fish. That's disgusting. You like the fillet of fish, family?
How could you?
It's not even fish, is it? Who knows what that is?
It's fish.
Put enough bread and get enough oil, fried oil in it. Everything tastes good.
Haven't you seen the square fish that swim through the ocean? Little fins. They just cut the fins off, fry them up. Little square fish.
All right, we're talking with John. John, you're with Allworth Money Matters.
Good morning, gentlemen. Making me hungry. Wife and I are selling our apartment residence in Cupertino. We moved into our formerly known as a rental. We have no debt. We're going to be getting about $1.8 million into our hands, not tax advantage. There's about $2.2 million in IRAs and Roth and 401ks and such. Still working, but trying to figure out what we should be doing with the proceeds from the sale.
So you sold a home in Silicon Valley, right?
Correct.
$1.8 million.
It's in contract, correct?
And change. Yes. We'll close next week, Friday.
And what's just to enlighten the rest of the country, what was that house like?
Like how many square feet? How old?
1727, 47 years old, townhouse, Cupertino, gated community, very quiet near a national preserve.
Nice,
beautiful, quiet
nice
area.
Neighborhood, but nothing special, right? You want to?
It was special for us.
Okay, but you can find that same
Idaho. You went to Boise, Idaho. You'd buy this thing for $300,000.
Oh yeah, or less.
Much less. Yeah.
Anyway, so where are you moving? Once
we moved about 10 miles away. We have a rental that became available when the tenant finalized her divorce, and she gave us 2 months notice, and she said, by the way, can I move out? Anyways, so we're happy. We have no debt. We're comfortable. We're more than comfortable. but we are going to have this money sitting non-tax advantage. Want to figure out, if you were to put it and you want it to be safe but not too safe, you don't want it to be earning 0.0% in a savings account or something. Where would you suggest?
How old are you?
55. Wife is 47.
How many more years till you retire?
Did that, tried that, didn't like it, went back to work.
And so 5, 6, 8 years.
How's your 401k allocated?
Pretty much total stock market for the most part.
Okay. So here's one of the things that you don't have any bond in your 401k or IRAs or Roth, right?
No, do not.
Okay.
0.
I would build, and what's your family income?
Call it $150 a year.
Okay.
You've done very well.
You've done great.
You've done really well.
I would build a 50-50 of index funds, tax efficient, and muni bond portfolios in the state of California. Scott?
Exactly what I was thinking, Jim.
Scott, what do you think?
Yeah. Or, you could put a little bond in your 401k. You're still young, right?
That's actually a really good idea. You could fill up the bond portion of that in.
It depends. It depends. It all is based upon your comfort zone, right?
But we could get to the same allocation of 75-25, right? So he's got $2 million here and 1.8 there. Split the baby. Put 100% equities, index funds in the brokerage account.
Or no, because you might use some of those dollars sometimes. But increase your allocation of equities in the brokerage account above the 50% that we were all just originally thinking, and then add some bonds in your 401k, IRAs, however, your retirement accounts. So you still end up with that
75-25, but you're using the bond and the IRA portion of the portfolio because it's more tax efficient, even than the municipal bonds in your brokerage account. Does that make sense?
Okay, but it does. But if we're talking about the non-privileged accounts, we're just talking about money.
I understand.
I know, but we're not. But what we're saying is we want to look at the entire portfolio, and if we're saying you might be better off having some other types of bonds besides munis to balance out your portfolio. And the way you're going to want to do that is through the 401k. So look at your total portfolio, because dollars are dollars. Just some happen to be in a tax advantage account that have other opportunities than you've got.
So you're going to get to a 75-25 equity to bond, and then you're going to use both the brokerage account and the IRAs to get there. And how you divide that is up to you.
Yep. And unfortunately, we're out of time. Thank you for the call. Thanks for being part of Allworth's Money Matters. We'll see you next week.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.